Okay, I believe we are live. Hello, everyone. Please give us some reactions if you see and hear us. We can. All right, great. So, welcome to the first Dealers Connect webinar, which we will host on the subject of AI in risk management. We have been researching this subject for quite a while, and we're happy to have three experts from the industry that are actively using it in their businesses. So we are joined here by Jakov Heidingsfeld. Sorry, Jakov, for my spelling, from Trader Tools. We have Ivan Kunyakin from the experts, and we have Michael Aulov from AIBI. We have here, I'm will be moderating this webinar along with Dr. Lazaros Zografopoulos. He's my colleague from Fintech, and myself, Roman Garanin from Fintech, as a CEO and founder as well. Just to quickly remind you that this podcast is sponsored and brought to you by Fintech and your boards, the companies that you guys may have heard so far several times. So let's start. Gentlemen, we would like to start with the use cases. How do you manage to apply the artificial intelligence with your cases? Let's start with Yakov.
Sure.
Could you please give us some highlights? How do you utilize it, and give us some context for us to see?
Sure. So, first of all, I'm Jakov Heidingsfeld. I'm one of the founders of Trader Tools. We've been providing foreign exchange trading technology to the markets since 1997. So we've been doing this for a while. About 4 years ago, we started incorporating AI in our price making functionality that we're offering to brokers. What we're doing with, first of all, the product is called Price On. And what Price On does is allows for algorithms to analyze the trading patterns that we're seeing coming in from our customers, doing AI pattern recognition, predictive analytics, and dynamic customer classifications. So the customer classifications, the algorithms categorize the traders into A book and B books by analyzing their performance patterns. That is done dynamically. Once that is done, we assign toxicity scoring. Based on the toxicity scoring, we do smart order routing, and we have risk management using those parameters. So that's super high level how we're using it. We differentiate the algorithms, the predictive analysis from backtesting, but we are performing both functions. So we feed the model, we train the model, we come up with results based on analyzing at least 3 months of trading history, and then we run it through a backtesting scenario, tweak the model, feed it back into the algorithm, and from there we go live.
Okay, very interesting point about scoring, the toxicity scoring. So basically, you define by yourself the toxicity, let's say, level of different behavior. Then you feed it to your model, and eventually the model goes through the clientele, right?
Correct.
But the question is, you have like a general toxicity scoring, regardless let's say the selection that you have like out of the current brokerage. But the model that you have is basically is being trained on like it's just only once based on your toxicity scoring that you generated, let's say once, and then you apply it to different data sets, or it actually adjusts together
It's
with the data set.
continuous. Yeah, correct, Roman. It's continuously adjusting based on new information that it is receiving back from the trading and the behavior of the customers. So we essentially have created two categories, and please don't laugh at the technical terms that we're using, but we essentially categorize all customers into two groups, two basic groups, lucky and smart, and then from 0 to 4 or 0 to 3 with 4 subgroups in each of those categories, lucky or smart. And the model actually knows how to differentiate based on time of day, based on instrument being traded. And so you could have a particular customer belonging to one toxicity group in Asian hours, in just trading dollar yen or just trading gold, and a different score for his European, that same customer in the European trading hours on those very same instruments. And based on those scores, attach strategies on A booking, B booking, and how to price those customers.
Sounds interesting. Okay. In terms of so basically, am I right that that your data, basically your model, is a very general, so you don't need to train it again, connecting every new brokerage, right? Is like I'm correct
Yep.
here.
The basic model is the same. So what we've done is we've taken literally millions of trades from various customers that we've had to do the basic data set training. Once we take that data set and then we take 3 months of trading history from the broker that wants to deploy the technology, and we feed his customer behavior trading history into the model to recategorize or to categorize his customers trading in those basic groups.
Sounds really intriguing. Would like to touch it further, but I believe it will be one of our next podcasts regarding the risk management tools. Let's just keep it at this level of depth for the time being. Lazare, from your side, do you have any questions to Yakov?
Yes, what I would be interested here is that you have a broker, different brokers have diverse client bases, and at the same time, it gets even more interesting if we think about the fact that even trading styles evolve over time. So, with respect to a client base and some insights, excuse me, the model can get. You train a model, you have some weights, ready the model to make some predictions, and then down the road, you have some different trends in terms of trading, some new customers joining with some different patterns, maybe some suspicious activity. And I was interested regarding the robust strategy here in terms of retraining a model, in terms of readjusting and tweaking a model down the road in order to avoid situations where the model is actually not updated, and based on an event as those that I described of some new waves of clients and suspicious activity, the model, how in this case will be able to predict and perform at a high level without being surprised by new events and new facts.
So basically, when one of our customers adds new customers to the data set, we categorize them as the lowest possible category, right? As that customer trades, we need at least a week to start moving him into one of those different 8 subcategories, lucky, smart, 0 to 3. We continuously update uh, that profile by reassigning that customer group on a weekly basis. What we found is that doing it any more granularly in less than a week is more curve fitting than actual predictive analysis. So we actually need to give the model enough trading information. And if the customer is not an actively trading customer, we may expand that window from 1 week to even 4 weeks to reassign them. But we would assign a new customer to the lowest risk category when he begins trading, meaning the most toxic.
Mhm. So there's actually in place a robust strategy in order to be ready to handle unexpected events, and based on the new information as it arrives, the model will be ready to take action. That is clear.
Correct.
Thank you. Mhm.
Correct.
Sounds interesting, and I would like to see that in action. But let's move because we have actually limited timing of 30 minutes. Thanks, Yakov. Was great. To be honest, didn't expect that level of details. Let's move to the next speaker, please, which is Michael. Michael, please give us the idea. How would you guys use the AI? Let's take it from
So my name is Michael Aulov. I am the CEO and one of the founders of a company called AI Global. We specialize in artificial intelligence and business intelligence. That's why AI. And we create reports for all departments of financial companies, of trading companies. But today we will be focusing specifically on risk management. And for risk management, one of the reports that we have with AI implementation is we predict whether a client is going to be is likely to be profitable, or is he going to be losing in the long run. And we do so by gathering the first 10 trades of the client and looking at the behavior that those trades are based on. And we found that early on, it is possible to avoid losses and to categorize them correctly. Would you like me to go more into details?
Okay, so just not very clear. Like, how do you categorize them?
So we give them a probability of how likely are they going to be winning in the future, meaning that if the behavior resembles basically gambling, then in the long run, the client is going to lose his money. Now, if the behavior is a lot more smart, as has been mentioned before, which I really like those two categories, as a matter of fact, lucky and smart, then the likelihood is much higher that the client will be profitable. So one of the examples is if the client has leverage and he just goes all in on a single position every single time, well, it's just a matter of time before he loses his entire account. Whereas if he has access to leverage and yet uses very little of it and diversifies, well, it looks a lot more like an investor rather than someone who shows up to have a good time.
In terms of this is clear, and I wanted here, though, to highlight the point that for these potential clients that could be interested in this technology and absolutely would like to explore the artificial intelligence space, there may be some consideration. I like to experiment on those lines. I like to introduce this new factor to the company, but I'm afraid potentially of some mistakes from the model, of how much a mistake can cost to me, what will be the consequences and the implications. So, in my research, in my academic research, what I was doing, and to make it concrete, is that when I was doing some predictive modeling, you had the trading, you had the validation test, and then you had the out of sample or the test set. So you were training a model on the training data set, you were testing in sample on the validation dataset, and when you are choosing with the correct parameters and the configuration of the model, you going out of sample, you go to the test dataset and evaluate its performance. So from this perspective, I would like to ask now, what are some measures in order to stress test these AI technologies before moving them to production, and in order to assess efficiently what is the output, what is the quality of the predictions here, and obviously be clear on how a mistake may cost or may not, and all those important factors for a broker and an owner to be aware of.
Mm-hmm. Yeah, this is actually a great question. And at the very beginning, when you have very limited amount of data, it can be quite challenging. And you might consider testing your models on a specific part of history, and then something that is more recent. I mean, like you would train on a part of history, and then you would be testing on something a bit more recent to see the behavior of that training in the past couple of months. Now, there is never at least in my personal opinion, there is never any guarantee of future results, right? Whether it's AI or not AI. But the likelihood of
If there was, none of us would be in the software business. We would train and trade our own models and all be able to retire a long time ago.
that is a good point. So that testing period, if the performance is fairly good, it's likely that the performance will be just as good for a little bit longer. Now, not indefinitely, but just long enough. Once you have enough data, once you work with multiple clients, once you begin to work with bigger clients that have large data sets, you can train the model on a large amount of data. And when you have a new client show up, you run the same model just on brand new data. And the entire data set of that client becomes your test data set. And you show the results and you just compare and you say, well, if you B book everybody, this is what would have happened. And if you A book, this is what happens. And in the great majority of time, obviously there is no 100% accuracy. If I see 100% accuracy in any of the models, my first thought is it's overtrained. This thing is useless. So there is never 100% accuracy. There would be mistakes, but the bottom line, does it bring value? Does it make money to the brokerage at the end of the day? And most of the time, like actually every single time so far from what we've seen, it makes money for the brokerage, and it's more than enough to cover our costs, like the cost of our service. So does that kind of answer your question, or maybe I missed something?
Yes, definitely. And at the end of the day, via a series of testing, you can essentially have some answers and quantify the implications and the results. That is clear to me. I have a follow-up here on a similar direction. In terms of, I want to touch a topic of modeling and using such technologies for these purposes. So you may have one school of thought that will say, look, guys, we are okay. We have some Power BI dashboards. We have some Grafana dashboards. We are doing our job. Then you have another school of thought that says we have these new technologies. We have to see how we use them and how we employ them to make money for the company. And then there is another school, I would say, and here I would play for a bit the devil's advocate, but I think it will benefit the overall discussion. Another school of thought will say, okay, having an AI model, training, configuring it is money, takes time, is money essentially. Why not just use some simpler linear statistical methods and statistical techniques rather than going to the non-linear setting and sophisticated models? And why not use some regression analysis in order to solve these issues and to have insights from that perspective?
I assume the question is directed to me.
It is, I would say to you as well, but overall, I think it is an
I think it's
interesting topic.
general question. I agree.
So if I may, I'll go first. I think it all boils down to results, right? The just cost benefit analysis. If your budget is very limited and you need results very quickly, then just go with regression. Just do something. If that helps you show results quickly and right now, that's a good way to go. With regards to AI costing a lot, that's why companies like ours exist, right? You end up purchasing a service, and when there's enough brokers that purchase a service, they don't need to pay nearly as much for development, and yet they get to benefit from large pools of data and large research and experience that goes into this. So I'm not against one or another, and I'm not even against other competitors or so-called competitors, because the models that they train and the models that we train, maybe both of them bring value to the table. So as long as we're able to make money for the broker, I think that's the bottom line.
Absolutely.
Gentlemen, Am I the only one, or will
If
the other
anyone,
gentlemen join in?
If anyone wants to comment on this, please feel free.
Yeah, I can add on to that a little bit. So to my understanding, yes, it is as simple as this. So if your like development and operational cost for the solution is below the result that you can provide with some margin, of course, well, it's okay then. And overall, it doesn't have to be it doesn't have to be some heavy lifting models, right? So as long as you have good quality data, as long as you have a lot of data, the solution can be rather simple. And you can gradually increase the complexity of the model if you see that there is room for improvement and there is some room for increasing the operational costs. So it's a rather simple trade-off.
Okay, given that Ivan has taken the word, let's discuss how you in the experts utilize the AI. Please give us some
All right.
insights.
Well, first of all, I'm leading what I'm doing at DevExperts. I'm leading a team of data scientists, and aside from other products and projects, we're doing this what can be called trading intelligence services. And basically, like specifically, these are understanding users' interests, user segmentation and profiling, and risk management. And with risk management, we've taken so far, right? Because these services they're not available yet. We're only planning on rolling them out gradually very soon, though. But still, with risk management, we've taken a little bit of a different approach from what will probably come first to mind when approaching such a task. Instead of predicting probabilities or assigning traders to different categories, we're trying to build a decision-making model that would, giving the trading history of a trader and some other data inputs, it would make a decision about the book that this trader should be assigned to. The benefits of such an approach is that this model and its goal, its optimization is directly connected to the business metric. So its reward signal, so-called, can be tied exactly to the revenue and to exposure. So we can maximize one and minimize the other. And that is why instead of having this proxy metrics, we're trying to optimize directly what our potential clients would need. Yep, this is in a nutshell. If you want me to go deeper into some part of
Yeah, I
it,
would like to have some practical
glad.
example on this, if you can.
Well, by example, you mean what would be the input and output of the model, right?
Yeah.
Something like this. Okay, well, for the input, as I said, there's some trading history that we can gather for this user, and if we don't have anything, well, there is something that we can do with this so-called cold start problem. But overall and generally, this thing is better working with some trading history for the user. So it's trading history and inputs from other models that are trained on different downstream tasks, because we found that it's also beneficial for the decision-making model. And as an output, we get the probabilities, not the probabilities, but the decision of whether this trader should be A booked or B booked, because the model during trading, it gets a signal from the revenue that can be generated one way or the other for this specific user.
So basically, you are kind of, instead of predicting, let's say, the profit, let's say, of the client, you basically go from the other side and say, okay, we would make more money on B book on this specific client, and we'll make more money on A book for that specific client, right?
Yeah, it can be put this way.
Okay.
I would
Quite
be
a-
interested in, if I may ask now, I would be interested in this point to understand what process do you have in place to prevent overfitting. So let's say you are working with a specific broker, hypothetically speaking. Broker X has a client base that at a specific, let's say, period, most of the clients are winning. Broker, let's say B, has a client base that most of the clients are losing. And then you have a model that does not really learn anything, but catches a trend and starts classifying everybody as a book or B-book, respectively. Which obviously, given the overall setting for this specific period, it will be correct, but in a naive way. Because when something shifts in either the client base or the market structure or some variable in the problem, then you have a model that is not prepared at all to handle the situation. And I would be interested to have some technical insight into this direction.
Absolutely. For preventing overfitting, you can work on different levels. So, for example, you can work on the level of training, right? There are some technical things that you can do for preventing overfitting. They're not that interesting right now. Then you can work on the level of data. And for example, you can work with the data. There is data augmentation, or you can upsize or downsize the data depending on the statistics of your data set. And obviously, the more data that you have, the better it is to handle overfitting. Goes without saying. And then there's the architectural levels, if you will. And on this level, you work with the model itself, with the model's architecture. So in our case, for example, instead of having this single model that is supposed to take all this data in and output this decision, right, we're doing it with several models, outputting their own scores, probabilities, latent representations, whatsoever.
Ensemble.
And then you can combine them into as an input for a decision-making model. And by splitting this process into different models, you first of all benefit from the fact that being trained on different downstream tasks, they are finding different patterns in the data. So it speaks for the quality of the decision-making process. And also you're preventing overfitting by this.
That is clear. Actually, yes, ensembles have so rather than relying on a single model and its potential weaknesses, you have several models. They can vote on something. They can create a collective decision, and
Yeah.
this has been shown to actually improve predictive ability, reduce the bias and the variance. So yes, it actually works in practice very, very well. That's clear.
An ensemble of simpler models is easier to be prevented from overfitting than a one large model. So, yeah.
Absolutely, yes.
I have a question actually to my colleagues that are doing what we're doing. We found that breaking down time of day, instrument being traded, and then matching patterns to maybe news events or market news in general has been very useful. Michael, Ivan, have either of you found those tools to be interesting as well, or are we either creating our own folly or leading the way?
I guess I'll go first. In our case, we are not using this type of data, but at the same time, I would say that you can take the same model, train it on a different data set, and it will still give you pretty good results. So it all kind of boils down to testing models and seeing what is the result. And just like Ivan was saying, it might be an ensemble of models. So and an ensemble might be using one model might be preferring one type of data, while another will be more putting higher weights on some other part of that same data set. So in my personal opinion, I think the more data, the merrier type of thing.
Yeah. Exactly. Well, I can go on. And as for the first part of the question regarding this granularity, right, of the data, part of the day, different asset classes, et cetera. Well, yeah, absolutely. We're going forward to having such an ability to assign different execution strategies to different levels, right? Not only on a trade level or an account level, but also being able to specify this sort of things as well. Now, for the this extra data sources like market sentiment, news, some events. These are very important, and we're yet to integrate those as well. But what I think here is that, well, we're partially doing so. Well, but first of all, training this model on this trading data, because it is already partially encoded, right? This market sentiment is partially encoded into the data as well, because, well, our trading data comes from different time periods, from different market conditions. So traders' behavior is already encoded into the model, first of all, and second of all, we're working with more like some heuristics about market sentiment and market conditions, like volatility, like overall turbulence, and other stuff. So we're not integrating news into the pipeline yet, and I'm sure there would be value from it. But we're trying to cover this by incorporating different sources of data, different statistical data, heuristics, etc.
Interesting.
We hope it answered the question.
Yeah.
So basically, the only question I have, and by the way, let me remind to the audience, guys, please feel free to post your questions because we're actually approaching the end of the session. Please feel free to post your questions here. While I have a question, kind of a generic one. How can we actually measure the efficiency of the tools that we do have currently? How do you guys manage to benchmark it against, I don't know, other tools and other methods?
Well, I'll start here. So first of all, we're looking at the profitability of the brokerage to start, and then applying the analytics and suggestions that we put in. In our reporting tool, you can actually move customers from group to group and see what would happen if you would have moved them at a particular point in time, from a particular point in time to a particular point in time. So the suggestions that we make show up in a report. The report shows historically what your A book and B book profit was, what your profit, and it's very granular, what profit you've made from spreads, what profit you've made from rolls. Okay. But then if I say, okay, I want to take this subgroup of customers that's knowledge level lucky 3 and move them to knowledge level lucky 2 or knowledge level smart 2, how would that affect the overall P&L of this group and of the overall structure of the broker itself? So that's a dynamic tool that's being fed in real time, right? Which gives you the ability to move customers or groups of customers from one group to another dynamically.
Okay. But this still okay. I have a concern that basically, as far as it's dynamic, may have been different in terms of the categorization half a year ago, right? So now is kind of a backtesting drawback, if we can call it like that. So
As I said, we combine both the predictive models and the backtesting to see how the results would have looked, okay, to provide some kind of a benchmark for the customer, for our customer, for the broker, to see, okay, if I applied these different strategies, how would I have done compared to how I actually performed?
all right, Michael, Ivan, you have anything to add?
A little bit. So first of all, yeah, of course, there is this backtesting side of it, and backtesting with different edge cases, different market conditions, etc., etc. But in terms of real understanding of how it would perform, there is no better way as to partially maybe deploy it, because backtesting just give you part of the picture, right? Because you don't know what would be, for example, the broker's terms of agreement with their LPs, their spreads, if they were to use your strategy, right? Because by using your strategy, they would assign their traders to different books, and by this change their flow. So you cannot tell how would their situation change with the deployment of your strategy unless you do it. So backtesting is just only part of the picture.
Right. Okay, Michael, what about you? Is there anything to
Um,
add?
I see questions from the audience, as a matter of fact, and I know that we're kind of running low on time, so I thought maybe we should address some of those.
Agree. Okay. All right. Let's basically we have several questions here, and I think the first two are basically more or less of the same nature. We have a question from Alexander, which is basically why to take first 5 trades, and and basically what if trader goes like what is how to avoid the random result. Basically, this is the essence of the question. And the next one from Rima is basically why to have 10 days, and basically if it's too little to basically to make a judgment. uh, Guys, and I believe those questions were during the uh, conversation between us and Michael and Yakov. Gentlemen, please feel free.
Um, so I'll answer Alex's question. So the question is, what if a client makes a profit in the first 1 to 5 trades and then goes for good? Which is a valid question, right? Maybe they just show up, they take a bite of the cake and just try to bolt, which happens. In some of those cases, you can use the some information about the lead, about the client, before they ever open a trade. So sometimes you can see maybe where they're coming from what IP address, what time of day, how long does it take them to upload documents. Sometimes you can generally, we do not work with personal client data, but you also can check for if you train a model on personal data, you might be able to categorize them quite early on that there is a high likelihood that they're going to just open a few trades, maybe like huge scalping trades, and then try to get out of to pull the money out.
But is it
So
feasible at all? Sorry for interrupting, but is it feasible like to get everything like personal data and stuff?
I think it is, especially if you hash the data, then you can share it. Because the only way to unhash it would be brute forcing, and that's quite difficult. So in that case, if you have enough cases, if you have enough of those cases of people showing up across many different brokers, at some point there needs to be some sort of pattern. Because in again, this is my personal opinion, but I believe that it's not a very big group of people, and if they trade just a couple of trades in one broker and they leave, they would likely go to another broker. So in that other broker, they would have a similar pattern. It's systematic. It's not random. It's not lucky. In that perspective. So I think there is a pattern. It just need to be found.
Okay, great.
There is some data that can be used even with this little number of trades. So we can come to some level of confidence about this trader. And also it depends on the risk appetite of a broker. So for example, they might decide that unless the model is confident enough about this particular trader, we want to avoid risk with them.
Okay. Regarding the question about 10 days from Rima, it's like if it's too little to assess, I believe, as I said, it's the same nature of with the previous question. Do we have anything to add here?
From our side, it's not 10 days, it's 10 trades.
10 trades.
Meaning it can happen within a couple of minutes.
Yeah, exactly.
So for us, we found that it seems to be quite enough to assess that. You can see quite a lot. Can say quite a lot about a trader within the first within those first 10 trades.
I agree with that. However, let's pass to the question of Yevgen, which I believe actually very interesting. I do have the same question. Have you ever faces the situation where you had absolutely the same inputs but different, let's say even random results sometimes from your models, and how you deal with those cases?
Well,
And
sorry, Yakov, go ahead.
I'll just go quickly and say that's not something that we've encountered. So
Okay, so basically the consistency is there in terms of outputs and inputs. Okay, and
Well,
Ivan and Michael from your side.
yeah, these machine learning models, they're like very complex math functions, right? So if, for example, if it's the same model with the same weights and the inputs are the same, you will get the same output. There are like stochastic models in there, but we're generally not talking about them. And even them will probably provide us with the same output. So it doesn't usually happen.
All right, so you haven't encountered this kind of behavior so far.
Not in this interpretation, no.
The only time that I've seen something like that was during training, when you add a random element and the model is assigning different weights to different data points, and then at any given moment you look at the same row with the same set of data, and suddenly it has different results. But this is part of training, that like it's exploring the different possibilities, it's assigning different weights. That's normal. But once it's trained, I don't think we've ever seen it. Like, if we run the same model on the same data and we get two different results, we begin to investigate to figure out like what went wrong.
there's a problem.
Yeah, there's a problem somewhere. This is not supposed to happen.
Yes. I think that the only setting that we could approach this point is if we think that we have a trained model, which, okay, if it takes the same inputs, it should give the absolutely same output. But when we retrain this model upon obtaining more data and potentially some new trends in the market or from the clients, then maybe something that was categorized in the past as low risk, maybe the model changed its perspective given the new data. That, for instance, here there are some signs of some pattern that in the past I maybe not be able to detect because it was just some outlier that couldn't learn from him. But now that I have a series of clients with a cluster actually of clients with same behavioral patterns, then now yes, I have indications and my weights can learn from these actual behaviors and activity to change opinion, maybe indicate something. I would say in this sense it could make we can interpret here like this.
All right. Still, would be interesting to see, like, okay, the inputs from, let's say, from your side, you have scorings, you have weights, you have basically your logic input already from your side, but the selection of users and their trading patterns are not always the same, right? So it differs from broker to broker. It can have different regional specifics and stuff. So this is, I believe, what was the question here, and Lazarus has properly clarified. But still, I believe you gentlemen replied this question, and you are happy with the consistency, let's say, of the models. Thanks a lot for that. I believe we can round it up, gentlemen. So
I think no, I would say no at this point because you have a very the perfect, I would say, question for the end, more philosophical
I
tone
didn't say it.
here.
Yeah.
What would be the future of dealing in such conditions? Predictive modeling for all client flow and making the decision from there could make the role relevant. So I think at this point we can address the future in terms of AI technologies being incorporated more and more to the dealing landscape, and how we evaluate the future. Do we see it right? What we can raise here as points.
All I'm going to say on the topic is, as being the senior member of the panel, I started dealing with telex machines. When Reuters dealing came out, they predicted the end of dealers. When electronic trading and aggregation came out, they predicted the end of traders or dealers, as the question was used, the word. I've been hearing about the prediction of the end of dealers' roles in the market as long as I've been in the business, which is this year celebrating its 40th year. I think we'll still be talking about the end of dealers in 40 more years.
Absolutely agree with that.
Yeah, I agree. I agree with that as well. And we have a huge way to go to get to a point of replacing human beings from especially high complexity industries like ours. And at the end of the day, somebody has to take the full responsibility for what's going on. Somebody has to see the big picture. And I think we're going to have dealers for a long time.
I agree. Okay, so we have 2 more questions left. Okay, there is one from Nicola. It's basically is an interesting question. I'm not sure if we can cover it fast, but let's try to be prompt here. So, in your opinion, what are the 5 most important triggers or value to categorize a client? Gentlemen, let's do it quick. Let's. I believe Yakov had a very interesting categorization of stuff. So we have. I would maybe simplify it. We have retail behavior and non-retail behavior, right? So what would be the 5 criteria for you guys?
I don't know that I look at it so much as 5. I look at it as risk appetite. So we're analyzing the behavior of the ultimate account by, I think Michael talked about it earlier, utilization of the leverage, frequency of trading, size of trading, right? So, but it's all about risk. So if you analyze the customer's risk profile based on his trading behavior, using whatever number of inputs you want, whether it's 2, 3, or 5, I think that's going to be the way you ultimately would accurately assess which category to assign a customer.
Okay. I agree. So basically, like, still, if we try to reply to Nicola's question, like specific things, first, leverage, effective leverage usage. I would agree definitely here. Second is how much is the cost of the client comparing to his P&L, or if you will, let's say the volume towards the profit. Right. So basically, this is the second one, and in general, but this goes on the long term only. Like short term will not be enough to analyze this metric. For me, is there are these 2. I wouldn't get on top of my head anything else. But okay, Nicola, feel free to reach out any of us after the webinar. And we have one more question from Ryan. Hi, given the non-linear volatility of the Forex market, how can AI predict rare events like flash crashes? Are adaptive learning techniques used to update models in real time? Great question.
Great question. Can I be the first one here?
Please.
Just want to say that yes, implementing continual learning is very important here because of the nature of the industry, right? The market conditions, it's all dynamic. We have to regularly update the model, and the shorter these iterations are, the better. And second of all, we're not trying to predict the market movement, right? Because it would be nearly impossible. We're trying to work with the traders and their behaviors, patterns, emotions, etc., etc. Market conditions like volatility can be an additional input to the model, and it can also be part of some manual, some rules that also affect the model's decisions. If it even if it's like automatic book switching, right? There should be an ability to pull the plug if some certain conditions are met. So I believe this is how you incorporate this knowledge into the model, not by trying to predict the market movement or this events, which are rare, by the way.
So Ivan, would you agree, because this is how we look at it at Trader Tools, this is a risk management function, right? So your client, the broker, needs to put guardrails on what risk appetite he has.
Exactly.
And if those market conditions lead to a breach of those risk appetite rules, then everything gets back to back. All bets are off.
Absolutely. Yeah.
My question to that same person would be, if you didn't have any AI prediction tools, would you be able to do better?
Great point. Great point, Michael. I believe we have one more question from Ryan, which is basically supplementary to the previous question. If a trader's behavior changes after 20 or 30 trades, how easily can AI model adopt to and detect the shift? What adjustments or decisions does the model make in response? And actually, I would add here how fast it will adopt.
So I would assume it's more related to to our model, since we are the guys with the 10 trades.
No, I would say I believe Yakov has the same approach, and basically it's self-learning and constantly updating, but just frequency.
I think
adapted.
Yakov's model is considering a lot more data for a longer time period, so they can easily encompass 30 or more trades. Please correct me if I'm wrong, Yakov.
You're correct.
So in our case, I would say that for our model, we have the 10 trades. This is the initial model. After that, there is another training that we're working on currently. Is again, it's more of an ensemble where we take the result of the first model for the 10 trades, and then we keep on checking, we keep on inputting this same result to another data set for another model to continuously check what's going on with the client. And if suddenly the behavior begins to change, to shift somehow, which is definitely possible, it just alerts you and it shows you that these specific clients need to be watched. You need to start paying closer attention to those specific clients.
So am I right that basically with every trade, every trade may shift the view of the trader in your case?
In theory, yes, but in practice, most of the time, the behavior is more or less consistent. The behavior would need to be drastically different and consistent from that point onward for the model to start raising an alert and telling you that, hey, something significantly has changed. Whereas if just one of the many trades is slightly different, I don't think that you'll get a significant difference.
And I add a little bit on top of that.
Yeah, that would be great.
Because our approach, since our approach is a little bit different, I thought you might be interested to know that, for example, we're not limited in amount of in the number of trades that we can take into analysis for a specific trader, but that creates a little bit of a challenge, so that because you need to understand that more recent trading history is probably more important than the previous one, right? For like a year ago or something. That is why we just simply use exponentially growing weights for the most recent trading history, right? And these trades, they affect the output decision about this trader more than the older trading history.
That makes sense.
LSTM model?
No, and it's not an LSTM model,
All
but
right, just out of curiosity. Yeah.
Transformers
Yep.
would be another candidate here, but we cannot reveal the secrets, I believe, behind the great recipe. But definitely in terms of modeling, in terms of having a loss function that you try to optimize for an objective, definitely you can put some customizable weight scheme in terms of how the models are updating, how they receive these gradient updates if we are talking about neural networks, etc. in other settings of model specifications, and therefore to put, for instance, more weight to the recent history rather than the past. So you have essentially an intelligent model that can adapt to this kind of situations, change in the more recent period of the behavior of the trader. So there are definitely ways to achieve this.
Agree. All right, guys, I believe we are a bit delayed in terms of our timing, actually twice delayed, but it was very interesting conversation. I'm looking forward actually to cover it further with you guys in future, maybe like in a bit more applicable sessions. For our audience, please, if you would like to contact any of the speakers of today's webinar, feel free to reach out either in Telegram group or directly to to the gentlemen here on the call. Everybody has LinkedIn, and so basically it's quite easy to get in touch. Please give us any further comments and top topics for the next webinars, and I believe we can round it up. And I would like to thank you, gentlemen. Thanks, Yakov, Ivan, Michael, and Lazarus. Was
Thank
a great
you.
Thank
pleasure.
you.
Thank you
And
very much. It was a real pleasure, gentlemen.
yeah, thanks a lot.
Likewise.
Bye, guys.